Welcome to JM Financial Mutual Fund's Fixed Income Outlook. In this short video, we would take a look at how different global and domestic factors behaved during the month gone by. We will also share our views on the domestic fixed income markets, which could, in turn, impact the positioning of our schemes. Global bond yields decreased last month, with 10-year US Treasury yield and 10-year Japan bond softening by 15 basis point and 16 basis point respectively. Benchmark 10-year German bonds closed flat while moving in a narrow range from 2.18% to 2.30%. The 10-year GSEC traded in a very narrow band of 6.92% to 6.85% and closed at 6.87% in August 2024, vis-à-vis 6.93% in July 2024. At the primary auctions, yields of 91-day T-bill, 182-day T-bill, and 364-day T-bill softened by approximately 4 basis point, approximately 7 basis point, and approximately 8 basis point, respectively during the month. Indian bond yields were lower broadly by 6 to 8 basis point, with exception of greater than 15-year bonds, as RBI decided to exclude fresh issuances from FAR bonds. Rest of the curve drifted lower in sync with UST yield movement and continuance of FII inflows. Real GDP in Q1, FY 2025 grew by 6.7%, lower than the robust growth of 8.2% in Q1 FY 2024 and 7.8% in Q4 fiscal year 2024, largely led by unfavorable base and lower government spending. Private final consumption expenditure, which accounted for 56.3% of the GDP, grew at the fastest pace in the last 7 quarters by 7.5%. Gross fixed capital formation or investments also grew at a strong pace of 7.5% in Q1 fiscal year 2025, despite lackluster government capital expenditure during the quarter. CPI inflation in June 2024 fell to 3.54% in July 2024, from 5.08%, led by a strong favorable base. The reading also came in marginally better than the Bloomberg's median poll of 3.60%. Food and beverages inflation plummeted to 5.06% in July 2024, from 8.36% in June 2024. Vegetables observed the modest inflation of 6.83% in July 2024, a steep decline from 29.32% in June 2024, largely led by a strong favorable base of approximately 3,816 basis point. Pulses and products have, however, maintained their double-digit price growth at 14.77% in July 2024, although marginally lower than 16.07% in June 2024. Also, cereals and products inflation remained elevated at 8.14% in July 2024. On the other hand, oils and fats and spices noted a deflation of 1.17% and 1.43% respectively in July 2024. In June 2024, the CPI ex-food and beverages stood at 2.2%, marking the 11th consecutive month below 4.0%. Core inflation surged slightly to 3.35% in July 2024 from 3.14% in June 2024. In miscellaneous items, personal care and effects and transportation and communication noted a higher increase. During July 2024, US dollar traded with a weakening bias and depreciated by approximately 2.30%. Strong rate cut expectation in the US following Jerome Powell's Jackson Hole Symposium speech, along with continued Japanese yen appreciation, JPY appreciated by 2.54% during the month, collectively contributed to US dollar index's slide during the month. Though Japanese yen appreciated during the month, it still remains substantially weak relative to Chinese yuan renminbi, Indian rupee, and Indonesian rupiah. Indian rupee depreciated by 0.17% in August 2024. Indian rupee traded in the range of rupees 83.72 to rupees 83.97 per USD during the month and ended the month at rupees 83.87 per USD. FPIs were net buyers in both equity and debt markets in August 2024, with inflows of rupees 7,322 crore and rupees 17,953 crore respectively. Forex reserves reached the highest level at $681.7 billion as on August 23, 2024 from $670.9 billion a month ago. Liquidity conditions during August 2024 were comfortable on the back of higher spending by the government. Even after the GST outflows, systemic liquidity remained in surplus. Systemic liquidity remained in surplus for the whole month, with average daily surplus of rupees 1,51,343 crore, compared to an average daily surplus of rupees 1,02,718 crore in July 2024. The daily average of weighted average call rate, WACR, stood at 6.52%, unchanged from the previous month. Adjusted for the government cash balances which are held by the RBI, the durable liquidity remained in surplus. Since June 2024, the RBI has outright sold securities worth rupees 17,175 crore in view to absorb excess liquidity, although the quantum of these open market operation (OMO) sales has been modest. Credit growth stood at 13.6% as on August 9, 2024 on a year-on-year basis, marginally lower than a month level of 14.0%. Similarly, bank deposit growth moderated to 10.9% as on August 9, 2024, from 11.3% a month ago. Credit growth continued to outpace deposit growth, which remains a key concern for the RBI. The economic indicators continue to show a mixed picture, especially with strong indicators such as robust GDP and retail spending. However, slowing labor markets and moderating inflation seems to have tilted the odds towards softening of interest rate stance by the Fed. The intent of the Fed to achieve long-term inflation rate of 2.0% on a durable basis remains a valid hypothesis. However, the incremental data for labor market shows greater weakness of economic environment. Three conditions that make the path for the Fed to start cutting rates much easier are: with the backdrop of strong fiscal spending, keeping interest rates higher for longer increases the burden of the interest expense on U.S. government. Real interest rates are significantly high. Currently, real rate in U.S. is at 3%, that is interest rate at 5.5%, and PCE for July 2024 at 2.5%. The U.S. Fed's dual mandate of maximum employment with price stability eludes the possibility that an unexpected weakening in the labor market can induce Fed easing, while solid job growth may not deter the Fed from pivoting if inflation is trending lower. However, scenarios of what can go wrong over next few months and the associated risks that remain are: yields at the longer end in U.S. may remain elevated as supply-side pressures persist, that is likely strong supply of coupon-bearing instruments due to the elevated fiscal deficit. This factor also gets weightage due to volatility in next few months on account of uncertainty regarding who ultimately wins U.S. elections. Markets would be made to guess the net effect of potential tariffs, domestic first policies, lower taxes, and resultant impact on inflation and fiscal scenarios. Given Japan's recent policy decision, yields of JGB may remain elevated, causing Japanese investors to further withdraw funds invested in UST as spreads compress. It's pertinent to note that Japan is the largest foreign holder of UST as of May 2024. Upside risks to inflation remain given the geopolitical conflicts, although commodities have moved downwards in recent weeks. Reasons for being cautious in India are: while domestic inflation is susceptible to volatility due to food components, continuance of resilient domestic growth necessitates no rush for softening in interest rates. Despite the flows related to inclusion in the bond indices beginning from June 2024, the Indian rupee (INR) seems to continue to be very range-bound. If our hypothesis of a weakening dollar remains valid, then fear of further INR depreciation reduces for now. The deposit credit gap in the banking system has sustained for a while, indicating that the shorter end of the curve may see higher supply due to the battle to raise deposits in the financial sector, thereby putting a floor for the overall curve. However, reasons capping the domestic yields are flows from offshore investors due to inclusion in the global bond indices from June 2024 onwards, which has resulted in a positive demand-supply equation. A reduction in overall fiscal deficit for the year as announced in the budget, with commitment to reduce it further over next few years. Fairly positive real rates, CPI for FY25, projected by RBI is 4.5% and REPO rate is at 6.5%, maintained for a while. Overall, the key monitorables for next few months are an interesting battle amongst various macros, central banks and countries. We have summarized the same below. 1. Bank of Japan, BOJ, versus Federal Open Market Committee, FOMC, central bank actions. Need to monitor the impact of Japanese investors choosing to invest incrementally in Japanese bonds as rates rise instead of US bonds as BOJ raises rates and FOMC cuts. And then what is the resultant impact on US bonds as US fiscal remains elevated over visible future? Second, DXY versus JPY versus CNY. Currency moves. Base case is DXY depreciates in medium term, which would be INR positive and positive for bond yields as well. 3. Donald Trump versus Kamala Harris. US elections, fiscal, growth, immigration, tariffs especially related to China. 4. Iran versus Israel, Russia versus Ukraine, geopolitics, impact on commodities and supply chain and thereby inflation. 5th. FII flows versus relative valuation of Indian rupee versus RBI strategy, open market operation sales and FX. Domestic dilemma, whether to choose flows and thereby appreciation in bonds and currencies, or to choose conservatism and build up currency buffers and maintain real rates higher. 6th, deposit war in banking system impacting shorter end versus structural macro story for multi-years, resulting in demand for longer end yield curve impact.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.